Awesome. Thank you all for being here, for joining our webinar today. Like I said, and like you just heard, we're going to be recording this to send out later for anybody who wasn't able to make it. And we're really excited for this. This is a conversation that we love to have with our clients on the financial planning side and on the tax side of our businesses. And so we wanted to share this with you all, since it's something we enjoy. We want to share it with you all at a high level as well. And so my name is Chris Wells. I'm the founder of Flourish Financial Planning. We are a fee-only financial planning firm that has an emphasis on charitable giving strategies, along with a few other things. I started Flourish Financial Planning about 7, 8 years ago, to be able to have to work with the people that value the same things that we do, and have these types of conversations with our clients. And so, let me also introduce you to a few members of our team that are helping us on the webinar today. We've got Alex here. Alex, you want to introduce yourself?
Yeah, hey guys, Alex Lozano here. Been in the industry maybe about 15 years, give or take. And I think between Chris, myself, and Jeremy, which will introduce himself here shortly, I think we're the dream team. We have a variety of experiences working with clients, and we focus on tax planning, financial planning, and optimizing your giving, right? Which encompasses all of that. So excited to talk about this topic, which is important to us.
Yeah, absolutely. Thanks, Alex. And, with this, I also wanted to give a shout out. You'll see a lot of our branding, Flourish Financial Planning, on the slides and everything that we're going through. And you'll hear mostly from Alex and I as we put a lot of the details around the webinar together. However, a big shout out to Jeremy and the Master Plan Tax Solutions team, because that's kind of our sister company. We work together on client situations and tax planning, because while we do financial planning, everything in your financial life has some sort of tax impact, right? And so Jeremy and their team really help out on that front with us. So Jeremy, you want to just introduce yourself real quick as well?
Yeah, Jeremy Andrews here, managing partner, Master Plan Tax Solutions, as Chris said. So, as he said, we want to be your advisor in all things tax, tax savings, and just glad to be here. Thank you guys for being here as well.
Yeah, thanks for your help helping to put some of this together and being the brain behind a lot of the tax things that we look at from a financial planning side of things. So just as a really quick high level overview of Flourish Financial Planning, I mentioned this early on. We wanted to work with people who value the same things as us. And so we primarily work with Christians, with believers who want to honor God with how they steward their resources. And there's some really beautiful nuances about that, on like what the Bible says about generosity and how that affects kind of giving, intersects with our faith and our stewardship. And this is a big conversation that we have with our clients, but that is not the focus of the session that we have today. So, if you actually want to see a little bit more about that, dive into biblical generosity and stewardship and giving principles, if all of that interests you, you can scan the QR code on this screen here, or you can text webinar to the phone number there, 817-799-7699. This is going to be an upcoming webinar that we have that's more on that topic, that again dives into stewardship and biblical principles about generosity. Today's event is actually going to be more focused on the actual tax mechanics and tax strategies with charitable giving. So I'll give you just a moment here to scan that if you're interested in there. And then this is an upcoming one. We're anticipating having this in December, in that December timeframe, early December. But on this interest form, you'll have the ability to kind of give us some information about, what times work for you, what you want to see involved in that conversation. We'd be happy to. We're excited to look through those as we prepare for that in December.
Yeah, and as you guys take a second to get that queued up, I'll shed a little bit more light on the agenda. So if we're not going to be diving too much into that, we are going to be talking about taxes, right? Charitable giving strategies have become more and more important with the changes in taxes. So many tax code changes have happened in this last decade. higher standard deductions, changes to itemization rules, changes to future tax reform. That's all uncertain. I was actually having a conversation with another professional, and we were kind of jokingly saying in tax code nowadays, things are permanent until they're not, and things are temporary until they're not.
Yeah.
And so our job is to be your advocate, right? And to help you be a good steward by bringing in knowledge, bringing in strategies that we help implement across the board with other clients to make sure that not only you, but also the charity are getting the biggest benefit and while taking advantage of all the strategies that are out there for you. And I think our goal for this webinar is simple: for you to walk away with some clear understanding of how some of these giving strategies can impact your taxes, go over some of the practicalities of these strategies, and overall maximize your generosity and reduce your tax burden. Chris?
Yeah. Yeah, well, it wouldn't be a good financial webinar without some disclosures. And so let me put these disclosures up for us. You can read them if you want. But essentially, what you should note is that this is for educational purposes only. What we're discussing on here, we're going to go over some strategies from a tax perspective. We're going to go over some of the mechanics of different tax planning tools and how to actually implement things. However, all of these things, again, for educational purposes and not advice to you. You need to loop in your advisor, your tax professional, your financial planner. They're going to be able to tailor any of these strategies for you specifically. Even if we are that tax advisor or financial planner for you, we don't implement just one strategy across the board for every client we work with. It's all customized to what meets your specific needs. So, in general, loop in any professionals before implementing any of this. Again, it's not advice; it's for educational purposes.
Right. All right. And just to set the foundation of kind of some of the terms that we're going to be using, so we're all on the same page, right? Let's talk about what's a charitable gift. We're referring to giving specifically to qualified organizations, otherwise known as 501c3 institutions, mostly known as churches, ministries, nonprofits, educational institutions, and so on. But not every gift either has to be or is deductible, right? Gifts to like political campaigns and non-qualified organizations can still be gifts, but may not qualify for some of these charitable deductions that we're going to talk about today. Now, again, on the same page, what's a deduction, right? So to put it simply, in the IRS's eyes, is something that reduces your income in all the IRS calculations. So it's important to know when you give $1, you don't necessarily get $1's worth of benefit as a deduction. When you give, for example, you give an example of $1,000 and you get $1,000 deduction. If you're in the 22% tax bracket, you just saved yourself $220 worth of taxes, right? So when we're making gifts, when we're talking about small, big gifts, know that of whatever gift size we're talking about getting a tax benefit, a percentage of that gift.
Right. Yep. It will never, for the most part, it won't ever be like I gave a certain amount and thus I got that same amount off of my taxes. It's always kind of a smaller portion of that. So that's how things start to get interesting here, because not every gift that is made, even to charitable institutions or 501c3s, sometimes you actually don't get any tax benefit from those. And here's why. This is what we're calling the itemized versus standard deduction. And so at a very high level, the IRS, at a very high level, the IRS gives you a standard amount as a deduction to reduce your income before they start calculating tax on that. And so that standard deduction is just over $31,000 now for married couples, and it is around $15,000, almost $16,000 for individuals. And so this means if your charitable gifts plus your other deductions, which are mortgage interest, some medical expenses, and some taxes, if those deductions, those itemized deductions, don't exceed that standard amount that the IRS is giving to you, well, then it's really not doing any benefit for you, right? There is a subtle nuance that comes with the new tax code that we'll talk about, but in general, you can think of this kind of like a hurdle or a threshold, right? So when you total up all of your itemized deductions that are on the screen here, you want to get over the standard deduction before you start getting any benefit whatsoever from that. So families could give $5,000, $10,000, $15,000 a year, and if some of their other deductions aren't very high, you may not even get to use much of that as a benefit, and you just use your standard. But that's where some strategies start to come in. We're going to go through a strategy that we call bunching in a second that helps to fix some of that issue, if you will.
All right. And then another important dates, speaking of the IRS and their dates, when do you need to make your charitable contributions? So depends how you're making it. If you're making it via check, you got to get that check postmarked by December 31st of the year that you want credit for. If you're doing an electronic transfer, the cutoff is the same 31st, but it's got to leave your account electronically. It doesn't matter if it's in the morning on the 31st or at 10 o'clock at night on the 31st. Those are the limits, but what we tell people, we encourage them, let's not wait for December, the week of December 31st, because I know you're enjoying family and New Year's and Christmas. Let's try to get all that done ahead of time and give us plenty of time to relax.
And also on that, sometimes the institutions, like if you're going to be using some strategies like a donor advised fund that we'll talk about in a second, each institution can have its own deadline. And so I've talked to some institutions where like the last 3 weeks of the year, if you didn't have paperwork filled out, you're not going to get that deduction for the current year. And so they'll set their own standards that'll be less than what the IRS is here.
All right. Another food for thought is when you make your charitable contributions, it really does depend on what you actually give to these qualified institutions. Most of the time, you're going to see situations where we give cash. And as you can see on the screen, that has a deductibility limit of 60% of your AGI for the year. So what does that mean? So if you make $100,000, if that's your AGI, right, not gross, that's your AGI, and you make a huge gift, you can only deduct $60,000 up to $60,000 worth if you donated cash. Now, in many other instances, and some of the examples that we're going to talk about, we're going to look at giving other assets that are not cash. And we'll talk about those in just a second. But some of those assets, those have a lower deductibility limit, which you see on the right side of your screen here, of 30% of your AGI. So again, in that example, if your AGI was 100 for the year, you can deduct up to 30% that year. Now, the cool thing about that is this isn't in terms of a limitation, it's not stopping you from making a gift. No one's going to stop you from making a gift. But that just means that if you exceed this limit, either the 60 or the 30, that you have up to 5 years to carry it forward to claim those charitable deductions into the future. And in the rare instances, right, that you're given an extremely large gift and that you may exceed that 5 year, it's really smart to work with a planner to make sure that we either know that up front or say, hey, if we're going to pass those 5 years, can we stagger it and extend that 5 year credit over time?
Yeah. And two, something to note is that 60% limit is kind of your overall with everything, not just cash. And so if you have given some cash and some stock, your stock gift is going to actually reduce your 60% limit, if you will. So those are some of the kind of mechanics and details on what to keep in mind when it comes to the tax impact of charitable giving. But we just had a new tax code change. And that may be why you're here, is kind of wondering to see like what is the new tax code, the OBBBA, that was signed into law in July. How is that going to affect my charitable giving? And so we're going to go through that. It is the One Big Beautiful Bill Act, OBBBA. That is a mouthful. It seems a little bit easier for me to say OBBA. And so if I say that, we're talking about the same thing here. So let's take a look at some of the impacts on that new code. First off, there's a new charitable deduction. Now, this is significant because we talked about earlier on that for a lot of people, if you're not giving enough to hurdle that standard deduction, you didn't really get any benefit from your charitable gifts. Well, this is a new deduction that was put forth by the OBBBA, and it is what, in this case, we're calling it above the line deduction. There's some chatter that it's not technically above the line. It's kind of been a new area of your tax return, but essentially, if you are not itemizing, so if you're using your standard deduction, then you still can get a deduction for $1,000 if you made $1,000 gift for single filers, or up to $2,000 for married couples, right? So if you have any kind of charitable giving, you're not at the point where you're itemizing. You can get up to $1,000 or $2,000 for gifts that are made to public charities. So what is not eligible here are donations to donor advised funds. And that's something we really want to call out because we really like donor advised funds. They are a tool to help with charitable giving for a lot of our clients. But in this case, you want to make sure that you're at least giving, if you're not planning on itemizing, you're at least giving some to charities directly instead of that donor advised fund in order to receive this deduction. So that is something new. If you have gone without kind of collecting your receipts for a while because you've said, hey, I'm never going to really reach this itemized threshold for my charitable giving, now's the time to keep some receipts and make sure that you have this added to your tax return. All right. Additional updates from this OBBBA. Starting in 2026, there's a floor. And so the floor for charitable giving is 0.5% of your AGI. And so only contributions that go over that will start counting towards your itemized deductions. And so for somebody, if you have like let's just use a $400,000 AGI, which is your adjusted gross income. The first $2,000 of your charitable giving just doesn't count. That's the 0.5%. It doesn't count towards your itemized deductions. And then anything that is under that baseline is not deductible unless it's carried forward. So what does this mean? If you're regularly below that threshold, you may not get a deduction unless you employ a strategy like bunching or use that first new benefit from the OBBBA.
All right. So those are a couple of changes for people that itemize. We call them itemizers and non-itemizers, right? Some changes with the OBBA. There is an additional change, and this really applies to the top end for the wealthy of us, right? That are all on this call, extremely wealthy, right? So there's always changes on the left side of the brackets and the right side of the brackets. So this change actually set a limit on the high side. Let's say for the Jeff Bezos that are on this call, if you're in the 37% tax bracket and you're implementing some of these strategies and you're looking to get that tax credit, right, that 30% as your credit, they've actually reduced that by a little bit to 35%, right? It's actually called the second 37th rule, all right? Something strange like that. But it just is limiting on the high side what high income earners are able to receive as a charitable deduction, right? It is a little bit of a change. It's about a 4 to 5% reduction in terms of tax credit. But what we're doing right now is highlighting that no matter where you are on the tax spectrum, left side, right side, high side, low side, that there's been changes with this just last legislation, not speaking of too much of previous legislations. And like we said, our job here mainly is to stay abreast of these for you. And if we're working for you, with you, or you're receiving advice from us, it's our job to make sure that we don't breach any of these limits or impact you negatively.
Yeah. Yeah. And so this is, one of those things that both of these things are put into place in 2026. And so, it's generally understood right now better to shift your gifts into 2025 if you're using a bunching rule or something like that. So let's continue on. We've hinted at it a little bit now, but we're going to go into some strategies. Again, these are just potential strategies. We're not recommending anything for you here, but we want you to know, hey, what should I be aware of? What is out there as I make decisions with our tax strategies? And again, I don't know if I mentioned this at the beginning, but at the end of our call today, we're going to be doing a Q&A. And so if you're going through this and we're saying something and you've got questions about that, there's a Q&A function at the bottom of your screen somewhere. And feel free at any point in time to start throwing in your questions there. And we will sort through those at the end of the presentation. We'll go through some Q&A for you. All right, let's go ahead and talk about strategy. So these are some of the things that we find are most effective for clients to maximize their generosity and keep some money out of Uncle Sam's hands. Again, not advice, not a recommendation, but something you should keep in mind and consider. So if you don't have a like-minded financial planner, feel free to reach out to us directly. We can kind of go through what it looks like. Again, our niche, if you will, is working in the charitable giving space and working with believers, especially in that space. And so we certainly can help with any questions that you have. First, we're going to talk about bunching. This is making your deductions work harder for you, and it's probably one of the most common and potentially impactful over time strategies to implement. So the idea here is that you lump your charitable contributions and your other deductions, whichever ones you can move, like your taxes, into 1 year as much as possible. Again, some things can't move, like your mortgage interest. You can't move your mortgage interest, but you can move your property taxes. Especially, we're based in the DFW area. Texas I think it's county by county, but they allow most places to pay your property taxes either at the end of the year or all the way up to January 15th of the following year. Well, you can kind of see where that helps with this bunching strategy is like you actually now can pick between 2 years to bunch some of your deductions into. And so that's the big setup here. If you look on the screen, these numbers were pre-OBBBA numbers. And so some of the numbers change a little bit where I have a limit of $10,000 on that state and local taxes. It's actually $40,000 for the most part for people now, which means you can actually utilize more of your property taxes or state and local taxes in this bunching strategy. So on this left-hand side, you can see without bunching. So this is just standard. All the bars are kind of the same all the way across. You can see, I think it's $15,000 of charitable giving in that dark bar. $10,000, which was the limit on the state and local bar there. And then I think it's close to 5,000 of mortgage interest or something like that. And it's the same all the way across. And then at the top here, this is the standard. It was the standard. It's gone up some. But this is the standard, which means you're always falling below the standard. And so you're always just utilizing this standard number, 30, 31 now. When we add bunching into it and say, hey, we can move our charitable giving around, we can move our property taxes around, we lump them into year 1 and year 3, so odd years. We now don't have any of those deductions in the even years, except for the things we can't move, like mortgage interest. And so we're way past the threshold in this first year. We're up past 40,000 because we've lumped everything in, but then we still get 30,000 in year 2, just the same as what we had in year 2 over here. And then we keep going back and forth over there. And so what you can see is as you lump things together, your deductions for a 2-year basis here, this is like 45,000 plus 30, so 75,000 over 2 years versus 60,000 over 2 years. And you can see how by lumping, you're able to get over the threshold more and then save more in you're getting more deductions in that, and thus the reduction in taxes. So in this specific example, that's 16,000 more in deductions while giving the same exact amount. If you were to assume that you're in the 22% tax bracket, that's a $3,500 reduction in taxes. So timeline on this. Let me go to my next screen here. You're going to use this back and forth. And some people, maybe 2 years of giving doesn't actually get them over the threshold, and they use 3 years. And it's better to do two, but we can also make it work with 3 years of charitable giving. But what we see here is you go back and forth every year of bunching and taking the itemized deduction, and then taking the standard deduction in the next year. Think of it as like odd and even years. And so one of the main things that people can kind of have a thought, maybe you're having this thought, is, well, I want the charities and the nonprofits that I support to receive a standard, constant, reliable stream of income and not lumpy amounts in even years and odd years. And that's probably one of the most common concerns with this. And we have a great solution, and that is the next strategy, which is a donor advised fund. So a donor advised fund is an account. It's like a charitable giving account that you can typically set up at, like, Schwab's got one. It's called DAF Giving 360. Fidelity's got one called Fidelity Charitable. There are some nonprofits like National Christian Foundation that has a great donor advised fund. And what these funds or accounts do is that you can throw your charitable giving into this account, and it is considered a gift to the eyes of the IRS in the year that it was given to the donor advised fund. So that's when you receive a deduction for it. So when the money goes into the donor advised fund, you get the gift, and then you start to send funds out to nonprofits and charities over time. And so your nonprofits can be none the wiser that you gave 2 years worth up front. In the example over here, you can kind of see we gave 2 years worth into the balance of the donor advised fund. And then you just continue giving your monthly gifts to the nonprofits and charities that you support. And it kind of slowly lowers the balance until you make it into that year three, where you're going to make your next lump sum contribution, and you give into that. There are some nuances that we can kind of go through. If you don't have the amount to put 2 years worth up front, we can do 1 year and monthly for a little while. There's different strategies that work to get your donor advised fund balance up so that you can do bunching. But yeah, nothing's off the table there. Another thing with a donor advised fund is you get to invest it as you wish, and so you can invest it in different types of investments, and now it can grow for you over time. And so I know people who, let's say that they expect to give $10,000 a year, but they give $12,000 into the donor advised fund. And so, like, their balance in their donor advised fund is growing by $2,000 every year or 2 years. And now that amount is invested and growing more and more, so you can make more significant gifts down the road. Now, two more things on a donor advised fund. One consideration is, because it's a gift in the eyes of the IRS, what you're doing is you're actually recommending grants to nonprofits, underlying nonprofits. And so once you make a gift to your donor advised fund, technically, in order for it to be a gift to the IRS, you have to be kind of hands off. And the way that they get around that is, when you're trying to send money from your donor advised fund to nonprofits, it is recommending a grant. And technically, the donor advised funds have to approve the grant out. We've never seen anything not approved by a donor advised fund. We're constantly adding charities to the donor advised fund platform to be sent out to all sorts of nonprofits. The donor advised fund companies, they don't want to deny any kind of recommendations, but that is just something that's important for you to know. Two kind of side benefits. Bunching is the main benefit for a DAF, donor advised fund. Two side ones is, one, you only have one charitable giving receipt that you really need to pay attention to if all your giving goes through the DAF. Because, and if you were previously supporting 10 organizations, you're trying to get receipts at the end of the year for taxes from each one. Whereas if you only gave to the donor advised fund and then dispersed it from the donor advised fund after that, you only need to pay attention to what you gave into the donor advised fund. You don't have to go collecting all the different receipts from the nonprofits at the end of the year. Also, this is a great tool for estate planning too. If you're wanting to list some charitable organizations and nonprofits in your estate plan, in your will or in your trust, you can, if you list out an organization like a charity and they change addresses or they go out of business or something happens, you're having to go into your estate plan, meet with an attorney, and fix up your will or trust. Whereas if you just list your donor advised fund, then your donor advised fund can do either gifts on your passing to listed charities, and you just log online to update the beneficiaries of that. Or your donor advised fund can actually kind of be a lasting solution over time. You can say, hey, I want my kids, if I pass away, I want my kids to step in here and start making these grants from my donor advised fund. And your now gifts inside of your donor advised fund can last for a long time there. So that's donor advised fund. If you have questions about it, list them in the Q&A section. We're happy to go through any of those afterwards.
Absolutely. All right. Donor advised funds are great. I think additionally to everything that Chris said is privacy as well. You can be as public or as private as you want to be when you make your gifts. I think that's important to a lot of us too. Now, donor advised funds is a tool. And part of those tools is another strategy is gifting appreciated assets. You can gift appreciated assets into a donor advised fund. Ultimately, our target is to get these to charities. Now, let me give you a high-level illustration that's going to make the point really clear. So when you're making your donations, your gifts, generally for the most people that we talk to, they're used to using cash because cash is king, right? And if you have a missionary in Uganda and you're trying to make a donation to him, they want cash, right? They don't necessarily need your car or assets, but not every qualified charity will take appreciated assets. But there is a very, very big tax opportunity to give appreciated assets. Let's go through this example here. Let's say that I wanted to make a $30,000 gift to a charity, and I have cash in my account, but I also have $30,000 worth of appreciated stock, appreciated funds in my investment account, right? These are non-retirement accounts. What is the difference? Why should I do one versus the other? So let's go to the example of actually giving the cash. So let's say that I didn't know that I could give appreciated assets, or that my donor advised fund didn't take my charity didn't take appreciated assets because they're a small church or something. So I take the $30,000 worth of stock and it has some gains because I've had it for a long time, and I have to sell it to turn it into cash, right? So if I go down through the scenario here on the left side of the screen, I sell the stock and I have to pay $3,000 worth of taxes. Now I got $27,000 free and clear, right? So if assuming you're at the 22% tax bracket. So this gives to the charity $27,000. You get a tax benefit of $2,940 to you. That's your net benefit, right? So you paid taxes and the charity received a smaller gift that you wanted to make. That's taking an appreciated asset and selling it, okay? There is an opportunity to give those appreciated assets, and I'll expand on what an appreciated asset is in just a second, and give those directly to the charity. So let's say in that same example, I had some highly appreciated stock. I'm sure you can think of some names off the top of your head. Instead of selling it, you can contact your charity or even contribute it to your donor advised fund. And that appreciation, right, in this example was $20,000 worth of growth. That appreciation continues, and neither you or the charity has to pay taxes on it. So on the right side here, if we follow this, I take the $30,000 stock gift, assuming it's long-term capital gains. give that to the charity or donor advised fund, now they get 100% of that value. And to put it simply, nobody pays the taxes, not you, not the charity. So they get 100% of the intended gift, right? That's my priority. But hey, there's a side benefit to that. Since no one paid taxes, you actually receive a higher net benefit for your charitable deduction down here at the bottom of the screen of $6,600. So one strategy, think of this, who might this be suited for? If you've held on to stock or mutual funds and they've appreciated over time and you have some long-term capital gains, instead of selling those, you can use those as the gift instead of giving cash, because cash is after tax. You factor in your taxes to see where your biggest benefit is.
Alex,
Yeah.
not to muddy the water too, but to talk about holding the stock short term. So if you've held it short term, less than a year, then your deduction is the equivalent of what you purchased it for, what your original cost basis. So in this example, if you purchased it for 25,000, even though it's valued at 30,000, but you've held it short term, you get the deduction of that 25,000, what you originally paid for it.
Exactly. And when you're gifting appreciated assets, we factor in and say, how long have you held it? How much has it appreciated? What's the tax benefit? Or is that stock or fund at a loss, right? We factor all that in when we're weighing what makes the most sense for your specific situation, right? I think we always start with your situation and then tell you, hey, here are your options, because as you're going to start to see, there is a lot of options. And you might be asking yourself at the end of this presentation, well, which one's the best for me? And the answer is, it might depend, right? That's the typical answer of a financial planner. Thanks,
Yeah.
Jeremy. Now, I mentioned earlier, what's an appreciated asset, right? Appreciated assets, it could be a lot of things. This example was for stock, funds. It could be a home, businesses, cryptocurrency, life insurances, collectibles, arts, for all the art connoisseurs on this call. So depending on the situation and depending on the assets, your deductibility limits can change, right? They could be as high as 60% for cash, 30% for long-term capital gains, and also being a qualified charity. Let's transition into what's called QCDs in our industry, or otherwise known as qualified charitable distributions. QCDs are unique to IRAs, not 401ks or other employer plans. They're unique to IRAs, and they're only available to you after the age of, well, the year that you turn 70 and a half. Now, what is a QCD? It's donating to charity directly from your IRA, not from your after-tax money, not from your, like I mentioned, your employer plan. And what's the difference with this? It's fairly unique because earlier we just mentioned there's a whole bunch of limitations of your AGI, that you can only gift a certain amount to get your tax deduction. A qualified charitable distribution it doesn't count towards your AGI or taxable income. Now, why is that important? Think of yourself that you're in that age 70 and a half age or over. A couple of things are beginning to happen, right? You are either took or about to take Social Security. You got Medicare that already started a few years ago. And so your AGI, your taxable income, does a few things, right? In terms of taxation of Social Security, in terms of Medicare surcharges. So being able to donate directly from your IRA means you don't pay tax. And again, we want the charity to get the max benefit that they can get. So after age 70 and a half. Now, what also happens around that age, a few years later, if you're not already in RMD phase, RMDs kick in at 70 or age 75, right? A qualified charitable distribution is a great tool to use in conjunction. If you take a distribution from the IRA and give it directly to the charity, not to your bank account and then to the charity, it's directly to the charity, you get to, one, satisfy that RMD. You don't increase your taxes, you don't your taxable income, and you don't pay the taxes, and your charity continues to get 100% of the gifts. So what are we considering? We're considering, all right, maybe in the past we've made donations from either cash or appreciated assets, but now it may be smarter to shift the source of those funds to maybe using your IRA, right? And the charity continues to get what you're normally giving to them, or if you want to make one-time gifts, you can use this strategy. What are some of the limits around this? In this year, 2025, single filers can give up to $108,000. Married joint filers can give double, up to $216,000, and that's per year. It'd be great to be able to do that annually, right? And we can definitely help you achieve that. Some of the nuances with this is it doesn't play well with donor advised funds. You can't take a qualified charitable distribution and put it into a donor advised fund. And otherwise, you can't roll it over into another IRA in case you ever wanted to do that. And there is some nuances if you live in a state that has state tax. Federal tax brackets and tax strategies aren't necessarily the same at the state level. In many states, you're going to get this exemption. In some of the other states, is going to say, hey, great, you got that federal benefit of QCDs, but at the state level, you might still have to pay a little bit of income. So looking out for that, but it's a great strategy to implement later on in life. Once you're in that retired phase and considering either mitigating your income, increasing income, and other issues like that. Now, I mentioned this one, I said it's a little bit different than all the previous ones that we discussed. Who would be a qualified candidate? Like who would really benefit from a qualified charitable distribution? Well, I would say you want to meet a couple of boxes. First of all, you want to be charitably inclined, right? And you want to think about who is the ultimate beneficiary of this IRA in general. Are you going to spend it all in your lifetime, or is there going to be excess money left over in your financial plan that you may want to pass on to your heirs? Because not to get into too much taxes, but if you leave an IRA to your heirs, they're going to pay the taxes. If you take the money from your IRA, you're going to pay the taxes. Otherwise, you use the strategy on the screen to donate directly to a charity and nobody pays the taxes, right? And I mentioned earlier, if you want to be cautious and mitigate your Medicare premiums, surcharges, and just don't really need any more taxable income, in your financial plan, it's a great strategy to bring up. Chris, I'll toss it back over to you.
Yeah, great. So those are some of the three main strategies that we're using with our clients. There are more complex strategies that are out there, especially surrounding charitable trusts. This is, again, more of an overview with the expectation that you're going to be working with an advisor that can tailor these items specific to your needs. And that really is important as we kind of wrap up and move into Q&A time here, is that you need to be working with a team of professionals that can help you. That's tax preparers, that is estate attorneys, that is financial planners, and they all help with different areas of your financial plan and your financial life. Like a solid tax professional is helping you with the reporting requirements and helping project out some specific numbers. Your estate attorneys are those that are going to help with the execution of gifting around trusts, drafting complex trusts, and your estate plan and gifting in your life, like at your passing. And then your financial planner almost acts as a quarterback with all of the different options that are out there to help you execute many of these strategies for you. We do this with our clients where we're actually helping choose, okay, one, we come up with a strategy of how do we, here's the amount that you're wanting to gift this year. How much goes in each of these different buckets of strategies to reduce your liability the most, and then what things can we execute on? Here's the specific stock and position that we want to gift. We actually do some with some of our clients on donor advised funds. They say, hey, I want to make this gift from my donor advised fund to this charity. We'll go in, we'll actually set it up and maintain the gifts for them out of donor advised funds or from stock gifts. And so it is good to connect with professionals that have the same values and expertise that you're kind of looking for. Like I said, Master Plan Tax Solutions is on here as well, our sister company from the tax side of things, and we have great recommendations for estate attorneys as well that we can get you if you have questions. All right, so in a moment we're going to move into the Q&A section. So go ahead and add your questions to the Q&A section if you have those. And as you're doing that, you're going to receive a few things after this webinar. One, again, we're recording it, so we will send that out to you afterwards. Flip it over to somebody that you say, hey, you may really enjoy this presentation. Additionally, we have a resource, like a checklist resource for you that goes through some of the strategies that we mentioned today with some items that are kept in mind. And again, you can use the code here back on the screen. If you were thinking like, hey, I would really love to be a part of that webinar in December around how this whole thing with charitable giving and taxes actually kind of shifts over into my faith and stewardship and what all of that looks like. That is going to be a really great webinar coming up that we would invite you to. So take a moment to scan this, or again, text webinar to 817-799-7699. We'll get you on that list, and we'll take, we have a few questions for you from there. Or you can email us at the information on the screen, or give us a call. All right. We've got about 10 minutes left, so let's open it up to questions. Again, if you have questions, drop them in the box. We'll start going through those. Let me see if I can take a look. Right. Okay. So, Alex, can you tell us what strategies make sense when? Like, we listed out a couple of things on here. Jeremy, if you have any insights that would help as well, we'd welcome those. I'd love to get y'all's insights. But what strategies make sense when out of what we're talking about?
So, see, let's start with the easy one. I think using a donor advised fund. Donor advised fund is very akin to a private foundation, but it's available to the masses. I mean, whether you're donating $1,000 a month, $1,000 a year, or $1 million a year, it is a very efficient tool and very low cost, if any, right? That you can contribute to one place to use to then distribute all of your funds. You can put some money in there. You can put a lot of money in there. One thing to note, it is irrevocable. For any money that you put into a donor advised fund, you can't take that back, right? And so these are conversations we have before then, is understanding your intentions behind gifting, charitable planning, and who you want to gift to, right? Just because these are some of the tools that are out there doesn't mean that we have to follow these tools, but they're ideally, right? They're ideal for certain situations. So I think a donor advised fund does a lot of things, gives you privacy, simplicity, and for me personally, ability to include the other people that are important around you, right? Kids, spouses, family members, to say, hey, these are the values in my family. This is what we like to do. This is what we love to do. And you start instilling those into the next generation, right? Without having to give them a full view to all of your net worth and everything that's going on. It's like, hey, let's just focus on what's really important to us and our family, which is charitable giving and planning, so on and so forth. I think donor advised funds provide a lot of flexibility to do that. I mentioned the more nuanced one, qualified charitable distributions, a great way to reduce income into retirement, right? Because the higher income we have, obviously the more taxes we pay, but it has a trickle down effect, taxation on Social Security, Medicare premiums, right? Which is an additional surcharge that you don't necessarily need to pay. So why pay it, right? And very high limits, and falls right in line with what we're looking to do sort of towards the end of life planning, right? Is we're thinking about that next generation and how we can not only provide for the next generation, but instill some of those behaviors and giving priorities with our family. This is a big conversation to be had with generational wealth. If you own a business and you want to continue sort of the same family priorities, I think those are the main ones that come to mind. Obviously, with appreciated assets, a great way to not have to pay the income tax on those gains, right? I think that would be it. I think a common scenario with using appreciated assets are I think nowadays a lot of employees are getting paid with equity compensation, restricted stock awards, restricted stock units, stock options, so on and so forth. You have to hold those anyways, and they become appreciated assets. That's a great opportunity to say, hey, this is a bonus. Instead of turning it into cash and then donating after paying all the tax, why don't I just give that directly? And what's an easy way to do it?
Yeah. Yeah, that's good. A couple of things that also kind of came to mind there is like if you have, we see this a lot where people are kind of in a diversification struggle where they have been given these stock grants from their companies, whether incentive stock options or just RSUs or something like that. They end up holding a lot of stock, company stock, and they are at a place where it's like, wow, this has grown over the last 5 years as I've been slowly accumulating it, but we need more diversification in our portfolio. And utilizing donor advised funds, charitable giving of appreciated assets in the diversification strategy has worked really well with a lot of our clients. Is if they were giving already, we can kind of loop in some of the giving from these appreciated assets, achieve, two birds, get two birds with one stone, if you will, and knock that out. Jeremy, here's a question for you. We had this similar one earlier. Um, is there what is the deductibility for somebody who is not yet a 501(c)(3)? And so if they're starting that process, when is the point of like I can gift to them individually or I can gift to the organization? Like when is it deductible if they're pursuing that 501(c)(3) process?
Good question. If you're giving a donation, if you will, to an individual, that is not deductible. Unfortunately, we have a number of clients that have given to needy families and whatnot directly. Unfortunately, it has to be a public charity. And when you're giving to a public charity, they either have to be a 501(c)(3) or in the process of applying for that 501(c)(3) to be able to be deductible. And, to be in the process, the IRS classifies that as having submitted their 501(c)(3) application, or what we call the Form 1023. If they're in that process and they're awaiting approval by the IRS, then the IRS says they're assumed to be a public charity, and so those donations are deductible.
Yeah. Yeah, great answer.
So either a 501(c)(3, public charity, or in the process of that.
Got it. Yeah, awesome. Another question on here. My spouse is working, building up their 401(k). What would be the strategy, like a giving strategy with the 401(k)? Now, I'll say to start here, as I've said so far, like a lot of this is not, we're not going to get into recommendations without seeing your entire picture. And that actually kind of goes into how I would kind of start to answer this from an educational perspective is if they are still working, they don't really have a whole lot of flexibility with the 401(k) that they have, right? Sometimes what we see is if they're not working, you can roll it into an IRA and start doing some qualified charitable distributions and things like that. But if they're still working, your plan actually normally states that you have to stay with the company, like the 401(k) funds are staying with the company. And so we would really be integrating this into like if we were to sit down with you as a client and kind of look at what a charitable giving strategy should be, it would be considering the 401(k) funds for probably future gifting or future lifetime use, and then looking at other present value, other assets that you have presently, that we could utilize in the strategy, if that makes sense. It's more of a look at the 401(k) as a puzzle piece for what the future holds because you can't really move anything around with it now. Considering that as we build out any other financial plan strategies that we're working on with you. Any other insights with that, Alex or Jeremy?
Yeah, I think I kind of tried to touch on it earlier. We've worked with clients where we start giving certain assets. Maybe we're giving cash while they were working, or we were giving maybe appreciated assets. And as we transition, right, think of life stages. Things happen. You retire, your income changes, your sources of income change. You end up in that retirement phase, and QCDs at the 70 and a half plus are a great strategy. Obviously, we want to run good analysis for you, make sure you have enough cash. There is actually a surplus for you to give, right? We what we try to do is and I stole this quote from somebody. We try to help our clients plan and manage their wealth so they can give away as much as possible, right? And by giving it away, it's thinking not necessarily to charity, but planning for other individuals. Now, to do that, we have to plan to make sure that you have enough, right? That's the big thing, number one, that you and your family have enough. And I think we do that through thoughtful planning and conversation to what you expect in your transition.
Yeah, good. Well, we're getting close to the end of time, so I've got one more here that I think we can squeeze in. It's kind of a two-parter. Are there minimum contribution amounts to open up a donor advised fund, and what happens to that if I pass away? And so I can start with that. There's a donor advised fund is kind of run from institution to institution. And so I've seen some institutions in the past that they say, hey, you got to have $2,000 in it or something like that. To the best of my knowledge, from what I've seen, there's no minimums on the donor advised fund that we typically use. And so I know it's out there where you don't have to have minimums to contribute. Um, and then what happens to it on passing? I think I alluded to this a little bit earlier on, but depending on the institution, the donor advised fund institution, you actually get to make a choice on what you want to happen with that. And normally there's two good options. One, you just say, hey, on my passing, you kind of list out beneficiaries of nonprofits, if you will. I want it to go X amount, 30% to go to this one, 30% to go to this one, and 40% to go to this one. And then on your passing, each of those nonprofits get a check for that percentage of your donor advised fund account. The other option, which I really like because it loops in some of the generational wealth planning that we get to have with our clients, is how do we get our kids more involved with the charitable giving side of things? Well, on a donor advised fund, you get a really unique opportunity to do that because you can actually list a successor trustee, I think is maybe what they call it, a successor grantor of the donor advised fund, where if you were to pass away, you can say, hey, my two kids, I want them to work together on this donor advised fund, and they actually continue to make grants from that donor advised fund on almost like it's on your behalf, but they're the ones that are getting to step into that. And so if you kind of loop your kids in on your donor advised fund early and say, hey, we've got some money that we need to give away from our donor advised fund this year, you can kind of bring them into the conversation on charitable giving. It's almost like charitable giving with training wheels, if you will, is like the gift has already been made. They get to just kind of go spread it out, which is cool. Yeah. Anything else on that? We're here at the top of the hour. Okay. Well, I really appreciate you all joining us today on our webinar. It's been really great to talk about this stuff with you. Again, these are some of my favorite conversations that we get to have with our clients. And so we would love to continue the conversation with you. If you have any questions, feel free to reach out. Again, we'll send some follow-up information afterwards. But yeah, we would love to be able to talk more as you wish. So, all right, y'all take care. Enjoy the rest of your afternoon, and we'll see you later.
Bye, everybody.